Most investors still believe that the risk is yet to come. But Warren Buffett does not. He has issued a rare warning. It has already started, and it's greater than anyone thinks. He is not predicting a potential collapse. He is already taking action. In this video, you will understand precisely what he said, what he is doing, and especially how you can also protect your wealth and your family. So stay tuned until the end. Just before we start, remember to like the video and subscribe to the channel to help me improve the videos. Starting from the beginning, the idea that an economic crisis has already begun, silently, may sound like an exaggeration. After all, the stock markets continue to operate, banks remain open, and governments insist that everything is under control. But what if all of that is just the surface? What if behind this apparent stability, we are already living through an inevitable deterioration at levels never before seen? Warren Buffett, known for his caution and rationality, rarely makes public alerts. Why is he at the last annual investors meeting of Berkshire Hathaway saying this now? What exactly is he seeing that most have not even noticed? This is not about predicting a crash. It is something greater than that. Worse still, this movement is already happening, slowly but structurally. Throughout this video, you will see why this analysis is not sensationalist, but rather logical. You will understand exactly the three comments that, when taken separately, sound common, but when combined, show that whatever it is, it has already started and is greater than anyone can imagine. So the question is, are you still acting blindly, or are you already preparing like Buffett? If the problem has already begun silently, where exactly did it start? This is where the first critical point comes in. Warren Buffett stated, "I think the problem of inflation is something terrifying, and it happens repeatedly throughout history. There is no perfect system to avoid this, and some governments naturally devalue their currency over time." When Warren Buffett says this, he is not referring to a temporary problem. He is talking about a structural phenomenon, recurring, persistent, and always destructive when ignored. And the most dangerous part, it does not warn you when it arrives. It corrodes silently. Currency, as Buffett rightly pointed out, is just the messenger. Inflation is the message. And the message has been clear. The cost of living is rising faster than most conservative investments can keep up with. Even in countries that have always been symbols of stability, price increases have reached historic levels in recent years. The cost of bread, gasoline, and rent is rising faster than you can keep track of. The issue is not just the number. It is the realization that even with all the tools available, there is no guaranteed shield against this invisible tax. And what happens to traditional savers in this scenario? They lose. Government bonds, savings, and even low-risk banking products have yielded returns below the real inflation rate across practically the entire Eurozone. This means that month after month, you are falling behind, even without making mistakes and investing every month. How can this logic be reversed? Firstly, by increasing your income. In an inflationary scenario, every additional euro you generate has double the value, because it not only covers the rising cost of living, it also allows you to apply other strategies that we will show later in the video with more strength. Buffett is a natural accumulator, but he achieved this only because he has always had consistent sources of cash flow. In your case, this could mean a second job, a side project, or acquiring a qualification that enhances your market value. Secondly, by reducing monthly expenses. It seems obvious, but almost no one does this strategically. The logic is simple. If you earn 100,000 euro a year but spend 100,000 euro, your net worth remains zero. Buffett measures success not only by how much comes in, but also by how much stays. And in an inflationary scenario, every euro saved not only helps avoid debt, but also gives you even more cash to invest. It is a tactic for both defense and attack at the same time. True protection against inflation lies not only in the assets you buy, it is in the behavior you adopt. Your consumption patterns, your ability to create value, and your discipline determine whether you will survive this cycle or be consumed by it. And this is just the first statement from Warren Buffett. The second is even more concerning and alarming. Warren Buffett does not often use words like scary, but when he looks at the fiscal situation of the United States, he does not hesitate. Fiscal policy is what scares me in the United States. We are doing something that is unsustainable, and if something cannot continue forever, it will stop. We are spending 7% of GDP more than we earn. That simply will not work forever. This statement says more than it appears. It reveals that the problem is structural. A deficit of 7% may seem like just a small number, but in practical terms, it means that the American government spends hundreds of billions more each year, without coverage from revenue. This needs to be financed. How? By issuing bonds. And who buys these bonds? Investors from around the world, including European central banks. Like a credit card without a limit, the government prints debt. And who funds this bill is us, directly or indirectly. The problem arises when these investors begin to doubt the government's ability to pay, not because the US government will default, but because the debt is growing at a pace that will eventually require inflation or financial repression to be controlled. Thus, the American fiscal risk is not an isolated problem. If confidence in financing American debt falters, the effect shakes the entire world, including here in Europe. European central banks maintain part of their reserves in American bonds. Pension funds, private banks, and institutional investors do the same. If interest rates rise or the dollar depreciates to attract buyers, the entire balance of global markets changes. And Buffett sees this clearly. He is not buying bonds. On the contrary, he is accumulating cash. Berkshire Hathaway has recently surpassed $300 billion in liquid assets, the highest level in history. This represents 27% of the entire portfolio. And it is not due to indecision. It is positioning. Here is a concrete action that any European investor can take. Accumulate cash with liquidity. This cash is not passivity. It is ammunition to act when prices retreat. And he only uses it when others are selling in a panic. This is how he consistently manages to buy great stocks at great prices. The second essential strategy is to focus on companies that have already proven resilience in previous crises. Buffett does not bet on narratives. He holds positions for decades in companies with a positive financial track record, like Coca-Cola and Apple, because they have traversed multiple cycles, delivering consistent profits, high margins, predictable cash flow, and products that customers cannot do without. This is where the European investor needs to make a decision. Follow trends or seek fundamentals. Because when a country's fiscal system begins to crack, only truly solid businesses remain standing. But what if the problem is not only inflation or debt, but the currency itself? This leads us to the third and most silent risk pointed out by Buffett. He said it in no uncertain terms. If you wanted to ruin the most productive economy in the world, you would do it through the currency. Obviously, we do not want to own anything in a currency that is really heading for hell. Inflation does not arise by chance. It is often a choice made by governments themselves to deal with debts, deficits, and public pressures. But the real risk is not waking up one day to find that your currency has totally collapsed. That almost never happens abruptly. What truly destroys wealth is the silent erosion of trust. It is when you continue earning in euro, continue investing, but realize that you can buy less and less with what you have accumulated. And this happens without headlines, without fanfare. It may seem distant, but it happened in a developed country like yours, the United Kingdom in 1976. The country, which was once the financial center of the world, lost control over its currency. Inflation exceeded double digits. Investors fled from the pound, and the government had to turn to the IMF, something unthinkable for a developed economy. The lesson there was straightforward. Trust is not regained by decree, and when the currency loses its credibility, everything else must be reassessed. Now, why does this matter directly to you? Who believes you are far from American volatility? I reiterate, the system is interconnected. If the main global store of value starts showing signs of wear, the market's response comes in a chain reaction. The euro has been under pressure before, such as during the crisis of 2011 and the post-pandemic stimulus. Even the Swiss franc, considered one of the safest currencies in the world, suffers indirect impacts when global fundamentals tremble. So how to protect your wealth and your family from the structural risks we are experiencing? Here are two more powerful tactics you can adopt. The first step is to stop relying solely on a single currency. Diversify your liquidity among currencies around the world, preferably strong currencies like the Swiss franc, for example, and in at least 3 of them. This is a rational way to reduce systemic exposure. Prioritize currencies with different fiscal fundamentals, lower correlations, and less synchronized monetary policies. Think of it as building a tripod of stability. This is exactly what Warren Buffett practices by investing in global stocks that generate revenue worldwide and raising funds in the bond market in yen, investing billions of euro in major Japanese commercial companies. The second step is to consider a significant portion of your wealth in non-sovereign assets. Gold and silver have outperformed any other currency throughout history. They are universal stores of value, do not depend on governments, and serve as shields against monetary shocks. Even Bitcoin, although more recent, serves a similar function, to be out of political reach. Although Buffett steers clear of cryptocurrencies, the concept of having part of your wealth outside the system through them has proven to be a great path for the average investor. But the big question here is not whether the currency will collapse. The pressing question is, if the currency is weakened, the deficit is expanding, and inflation is advancing. Why does Buffett seem so calm? What does he see, and has already adjusted, that most still ignore? Buffett is not trying to predict chaos. He is simply observing the fundamentals and acting in advance. And that is the difference between those who survive and those who thrive in difficult cycles. Today, we saw how the process has already begun. But we demonstrated that it is possible to respond rationally with practical actions to all this so that you can also thrive. Cutting costs, increasing earnings, diversifying currencies, buying real protection, and accumulating cash with liquidity. This is the foundation. If this made sense to you, please like the video and subscribe to the channel to always receive alerts from great investors and to learn how to survive crises. Also, leave a comment stating which of these strategies you are already applying. Prepare yourself while there is still time. We will see you in the next video.